Enjoying the rate cuts? What's coming next? Let's find out. Hello friends, today we will discuss in this video why the interest rate was reduced on July the 24th and what is going to be the impact of this change. As you all know that we are running a promotion that when we reach 2000 subscribers, we'll pick one name from the list of subscribers and the winner gets $250 Costco gift certificate. The name of the winner will be announced on this channel. And I want to thank you with all my heart for making all my videos a super success. You're watching my videos in huge numbers, friends. Thank you very much. And since you are already watching my videos, friends, please click the subscribe button. Your name could win a $250 Costco gift certificate, and I wish you all the best for the same. Coming back to today's most interesting news in Canada. As we were anticipating, and we have been discussing it in all my videos and all my radio interviews, that the rate of interest could go down again on July the 24th, and exactly the same has happened. The Governor of the Bank of Canada, Lic reduced the overnight rate of interest in Canada from 4.75% to 4.5% now. This 0.25% reduction came after reducing the rate in June as well. So this is the second consecutive rate reduction. This decision marks a significant shift in the central bank's monetary policy, aiming to bolster economic activity and address growing uncertainties. This is the second rate cut since the pandemic-driven economic crisis, signaling a proactive approach to counteract potential economic slowdowns. This is what Tiff Macklem exactly said. He said that there are three major considerations coming out of this change. The number one being monetary policy is working to ease broader price pressures. Second, with the economy in excess supply and slack in the labor market, the economy has more room to grow with creating inflationary pressures. And the third one, that the inflation is finally getting close to the 2% target rate. Now here is a brief history of the Bank of Canada's interest rate change. For a long time during the COVID-19 pandemic, the Bank of Canada left its overnight lending rate at 0.25%. However, in March 2022, amid rising inflation and the outbreak of a war in Ukraine, the Bank of Canada started raising its interest rates and raised it by 25 basis points to 0.5%. Over the following years, the Bank of Canada raised its rate several times in an effort to help combat rising inflation, culminating in July 2023 when the overnight lending rate hit 5%. Then the Bank of Canada held that rate until June the 5th of 2024. With the continued evidence that underlying inflation is easing, the Bank of Canada's Governing Council agreed that monetary policy no longer needs to be as restrictive and reduced. The inflation right now is at 2.67% as of June end 2024, which has dropped from an overwhelming 8.1% in February of 2022. Now the recent data has increased our confidence that inflation will continue to move towards the 2% target rate. Nonetheless, risks to the inflation outlook remain. The Governing Council is closely watching the evolution of core inflation and remains particularly focused on the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior. The bank remains resolute in its commitment to restoring price stability for Canadians. The Bank of Canada's interest rate policy has an impact on the rate at which all Canadian banks will lend money to businesses and individuals, which include mortgage rates. As a result, the prime lending rate, which on June the 4th this year was 7.2%, has now dropped down to 6.7%. What does this second consecutive rate decision mean for Canadians? Now that the Bank of Canada has made its second change to its overnight lending rate, homeowners with a variable rate mortgage could see more of their money going towards the principal amount on their mortgage and less towards the interest. That means that a homeowner could possibly pay off their mortgage faster than in a higher rate environment. Now, for homeowners on a fixed rate mortgage, this rate cut may be helpful but might not ease all affordability concerns because their mortgage is already locked in whatever rate, but the cost of living apart from the mortgage is going to be helpful for that as well. Now, even if the interest rates started to come down, people who have fixed rate mortgages that are up for renewal may renew at a rate that is higher than what they had before, especially if they had secured a mortgage during the thick of the pandemic when interest rates were at historic lows. The rate situation in 2024 is different than it was a few years back. Now, while there has been some speculation that the Bank of Canada might hold off on cutting its second overnight lending rate until September, the central bank opted for another cut. The Bank of Canada's decision could have big implications for the Canadian housing market, especially if further rate cuts arrive later this year. Many Canadians, especially first-time home buyers and existing homeowners looking to renew their mortgage, have been watching the central bank's rate decisions carefully as they affect the rate on which the Canadian banks can lend money for loans like mortgages. Because the Bank of Canada's benchmark rate serves as a reference point for the interest rates that financial institutions charge to their customers on products such as mortgages and loans, the Bank of Canada's decision means that people with variable rate mortgages, the mortgages that fluctuate with rate of interest hikes or cuts, could soon start to see some financial relief. Now, while I believe that the Bank of Canada did not want to wait any more longer to cut rates, this was the right time and has signaled millions of people in Canada who are holding to buy a property. Now is the time, and the rate of interest will further keep going down at least up to 1% this year and approximately 1% more in 2025, and looks like it will continue in 2026 as well. And this rate cuts, as I said, are just the beginning of a larger trend from the Bank of Canada. If you're liking this video, friends, please smash the like button. It will help the YouTube algorithm and ultimately this channel, and your name can also be drawn for a $250 gift certificate. Coming back to the reasons for this beautiful rate cut. The rate decision to reduce the interest rate comes amidst several economic challenges. Chief among them is the sluggish growth in domestic and global markets. Recent data indicated that Canada's GDP growth has been slower than expected in the first quarter of 2024, with significant contractions in key sectors such as manufacturing and retail. Inflation rates have also been a concern. While inflation has peaked earlier in the year, it has since shown signs of moderating. The central bank aims to ensure that inflation remains within its target range of 2%, and these rate cuts are a part of this broader strategy to manage price stability. Additionally, the global economic outlook has been clouded by uncertainties, including geopolitical tensions and trade disruptions. These factors have collectively contributed to a more cautious economic environment, prompting the Bank of Canada to take a preemptive action to support growth. Now, coming back on what will be the impact of these rate cuts on the Canadian economy. The reduction in the interest rate is expected to have several immediate and long-term effects on the Canadian economy. Stimulating borrowing and spending is the number one. Now, lower interest rates typically reduce the cost of borrowing for consumers and businesses. This can lead to increased spending on goods and services, thereby stimulating economic activity. Homeowners in particular may benefit from reduced mortgage rates, potentially revitalizing the housing market. Second, it encourages investment. Businesses may find it more attractive to invest in expansion and new projects due to lowering financial costs. This could spur job creation and innovation, contributing to overall economic growth in Canada. And the third one is currency depreciation. A lower interest rate can lead to a depreciation of the Canadian dollar. While this makes imports more expensive, it can also boost exports by making Canadian goods and services more competitive on the global stage. This could help narrow the trade deficit and support domestic industries. Now, financial markets have responded positively to these rate cuts. Investors seemed reassured by the central bank's commitment to supporting the economy. However, not all the reactions were favorable. Some analysts cautioned that the rate cut might signal deeper issues within the economy that could require more than just monetary policy adjustments. There are also concerns about the potential for increased consumer debt levels, as lower interest rates can lead to more borrowing. Now, the Bank of Canada's decision to lower the interest rate underscores the complex balancing act central banks must perform in navigating economic challenges. By reducing the cost of borrowing, the central bank aims to stimulate economic activity and maintain price stability amidst a backdrop of global uncertainties and domestic economic concerns. As the effects of this policy shift unfold, stakeholders across the economy, from consumers and businesses to investors and policymakers, all will be closely watching to gauge its impact on the Canadian economic trajectory. Now let's discuss what will be the impact of this rate cut on the Canadian real estate sector. The recent decision by the Bank of Canada to lower its benchmark rate in 2 months, approximately 50 basis points from 5% to 4.5% in 2 consecutive months, as I said, is poised to have significant implications for the Ontario real estate market. As one of Canada's most dynamic and diverse real estate markets, Ontario stands to experience a range of effects from this policy change, impacting buyers, sellers, investors, and the broader economy as a whole. Now, lower interest rates generally translate to reduced mortgage rates, making borrowing cheaper for prospective home buyers. This reduction in financing costs can lower monthly mortgage payments, making home ownership more accessible to a broader range of buyers. In Ontario, where housing affordability has been a pressing issue, this could now lead to increased demand for homes. Now, the first-time home buyers in particular are likely to benefit from this rate cut. With the lower mortgage rates, the barriers to entering the housing market are reduced, potentially leading to a surge in home purchase applications. This increased demand could drive up home prices in the short term as more buyers compete for affordable available properties. The reduction in interest rates is expected to spur an overall activity in the housing market as well. Sellers might find it easier to attract buyers, leading to quicker sales and potentially higher sale prices. Real estate agents and brokers may also see increased business as both buying and selling activities pick up. Now, in the condominium and townhouse segments, which are more popular among the young professionals and small families, these rate cuts could result in heightened interest and faster turnovers. Similarly, the market for detached homes, which has seen a significant price appreciation over the years, might experience renewed vigor as financing homes becomes more affordable. Lower interest rates can also make real estate investments more attractive. Investors looking to purchase rental properties or engage in real estate development may find it more feasible to finance their projects. This could lead to an increased supply in this of rental properties, potentially stabilizing or even reducing the rental prices in the long term. Additionally, lower borrowing costs might encourage more foreign investment in Ontario's real estate market. International investors, attracted by the relative affordability of borrowing and the stability of the Canadian economy, might contribute to increased demands for high-end and commercial properties. The impact of these interest rate cuts in Ontario real estate market is likely to extend just beyond property transactions. Increased activity in the housing market can stimulate related industries such as construction, home renovation, and retail, especially for home furnishings and appliances. This can also contribute to job creation and the economic growth in the province as a whole. Moreover, as more people purchase homes, there might be increased demand for public services and infrastructure, leading to potential growth in municipal investments and developments. While the interest rate cut presents several opportunities, it also brings potential challenges. And one significant concern is a risk of exacerbating housing market imbalances. If the demand significantly outpaces supply, it could further lead to overheating in certain segments of the market, driving prices to unsustainable levels. There is also a risk of increased household debt. Lower interest rates always encourage more borrowing, leading to higher debt levels amongst Ontario and Canadian residents. This could pose long-term risks to financial stability, particularly if economic conditions change and the interest rates rise again in the future. So, in conclusion, I can say that the Bank of Canada's interest rate cut is poised to have a substantial impact on the Ontario real estate market. By making borrowing more affordable, the rate reduction is likely to stimulate demand, increase market activity, and attract investment. However, the stakeholders must remain vigilant about potential market imbalances and the risk of rising household debt. As the effects of this monetary policy change unfold, the Ontario real estate market now will be closely watched by buyers, sellers, investors, and policymakers alike, all seeking to navigate the opportunities and challenges presented by this new economic landscape. And finally, I can predict today that in the middle of summer of 2024, these rate reductions will fuel consumers' sentiment, and people who have been holding back will come to the fore and take advantage. This will also pump the refinance market. People who have been stuck with credit card debt and the higher interest rates on mortgages can now refinance and pay off their debt and make their life better. All this money that is saved from interest payments will now go into consumer spending and will increase the GDP of Canada. So friends, if you're looking to find more information about this on your refinance or your mortgage, as debt level has piled up and you need some extra cash in these tough times, you are exactly where you want to be. Take advantage of this scenario. And for people who are looking to enter the market, there is no better time, as these rate cuts will not only improve inventory, the cost of borrowing will be low, and finally people who are not qualifying will get qualified for a mortgage as well. And as Tiff Macklem, the Governor of Bank of Canada, said, yes, we can certainly expect more rate cuts to come. I can predict again that there will be around 2 more cuts in this year to make a total 1% cut in this year of 2024. It will be followed, as I already said, again in 2025, and looks like will continue in 2026 as well. Should you have any questions, my friend, anything about this thing, please feel free to call me and we will discuss all your concerns. Take advantage of this current scenario and save money for your family. When you call me, we will discuss how this current scenario will benefit you. Looking forward to all your queries. And stay blessed, be safe, and see you in the next video with another topic very soon. Thank you.